Hello, this is Mijun from Beer Salon University. Let's begin today's Beer Salon news for November 18th. Welcome once again to Mijun, where we consistently uphold the fundamentals of investing in United States stocks. I've mentioned this to you before. There are quite a few things we need in order to be happy, but before we can have what we need, there's one prerequisite. Avoiding problems is most important. So it's not that we're unhappy because we don't have much. If too many problems come into your life, it's often the case that you become unhappy because of them. So as much as possible, removing problems one by one is the first thing you should do. I think that's the first condition for happiness. My family and I recently moved from the United Kingdom to Malaysia, and we did so with the same mindset. There are many good things about the United Kingdom, but when you live there, there are often things that can be quite upsetting in various ways. So, rather than living in an area with so many problems, we decided to move to Southeast Asia, where the conditions allow us to reduce some of those problems and be a bit happier. And over the past 3 months, we really haven't had any major issues, so I've had a lot of positive thoughts about our move. Today, for the first time since arriving in Malaysia, something truly upset me. So today, I was feeling really down and having a hard time, and I even thought about taking a day off from streaming. But today, of all days, I also have something busy tomorrow, so I can't stream then either. Recently, the United States stock market atmosphere has been poor. So I sat in front of the camera today, thinking that I should at least do a short stream for you. Like I mentioned earlier, the fewer problems you have in life, the higher your chances of being happy. In that sense, achieving financial freedom is important too. Having a lot of money doesn't guarantee happiness, but at least financial problems. Today's topic is quickly. Today, I'll start by reading a comment left by one of our precious subscribers. The first comment I have prepared is a valuable message left by Kim Urin. Hello Mijun, I subscribed to your channel last April and now I'm seeing a lot of profit. However, I'm looking to receive cash every month to use as living expenses in my late 60s or 70s, so could you recommend some monthly dividend stocks? In the later years of life, I think it would be truly happy to be able to leisurely have tea with friends and treat them to a meal. I would be really grateful if you could please answer. Although there are many recommended YouTube channels, I trust you most, Mijun Nim. Your recommendations make me feel confident investing, which is why I'm asking these questions. Since you asked so politely and earnestly, I couldn't just ignore your request. Since as many as 12 people clicked, I think a lot of people are expecting an answer to this question. So I actually made a special Mijun content just to answer this question. Let's listen to it. First of all, as for me, personally, I think investing in individual dividend stocks is actually riskier than investing in individual growth stocks. The reason is that, as the world is changing so rapidly, companies that are in the mature stage and actively paying dividends are more likely to fail to adapt quickly to these rapid changes. I have this kind of concern. So, if you feel that you absolutely have to invest in dividend stocks, for those of you who think that way, as the world evolves, the stock prices of companies change constantly, and these changes are reflected at least once every 3 months or once a year. So, in my personal opinion, ETFs that replace investment stocks can be a somewhat safer investment option. So, if you can be satisfied with a dividend yield of 4% or less, there's one exchange-traded fund I'd like to introduce to you, the SHIAP United States Dividend Equity Exchange-Traded Fund. You can see the ticker name here. You've probably heard of it a lot. There's an exchange-traded fund called SCHD. Right now, it's a popular exchange-traded fund that's chosen by many investors in the financial world. Sometimes it's also called SHD. The way SCHD selects its stocks and its rebalancing criteria are very strict. That's why I'm introducing it to you today. I've summarized it as follows. All right, SHD tracks the Dow Jones United States Dividend 100 Index. And the key point of this index is that it combines consistent dividends with strong fundamentals. So it's not just about looking at dividends, but it also continuously checks how strong the fundamentals are for us, and I really like that part. Now, let me introduce the criteria for selecting stocks in SHD. SCHD selects 100 stocks through the following 4 steps. First, there is something called the Dow Jones United States Broad Market Index, and the selection is made from the stocks included in this index. REITs are excluded here, and real estate companies are also excluded. Please keep this in mind. Second, there are several strict criteria. The company must have paid dividends for at least 10 straight years. If they missed a dividend even once in that period, they are excluded. That's pretty strict, right? And secondly, the size requirement is also strict. The company must have a market capitalization of at least $500 million, so small companies are excluded. Third, it must have ample liquidity. Only companies averaging at least $2 million in daily trading over the past 3 months are included. Now, that's not all. Now we screen using fundamental criteria. For stocks that pass the second stage, they assign a comprehensive score based on 4 fundamental factors. Now, there are 4 indicators. The first is free cash flow to total debt. So, compared to the debt, how much free cash flow do they have right now? In other words, it's about how quickly they have the ability to pay off their debt. And second, return on equity. This is the return on equity we learned about in detail last week. It's very important to see how much profit is being generated with the capital you have. Third is the dividend yield, which is the return rate from dividends. Lastly, what is the 5-year average annual growth rate of dividends? So it's not just about giving a lot of dividends, but also about how much the dividends continue to grow. Taking this into account, they say they give a comprehensive score based on these 4 fundamental factors. And then, based on the comprehensive scores from the 3 stages, the top 100 stocks are finally selected to make up the exchange-traded fund. But it doesn't just end with this strict selection process. They also do rebalancing. Criteria exist to set and regularly adjust the weights of the 100 selected stocks. First, they use a modified market capitalization method. What does this mean? You see, it says modified. Weights are based on market capitalization. It's the same as the S&P 500 and QQQ. So if the market capitalization is high, the weight is higher. That's the same. The problem is that the weight of an individual stock cannot exceed 4%, and the weight of an individual sector cannot exceed 25% of the entire portfolio. So, you can see that there are conditions to prevent excessive concentration of funds in a particular stock or sector. And they make regular changes. First, they do a rebalancing. Every March, they reapply the 4-stage criteria mentioned above. They review and replace the 100 included stocks every year. Once again, they rank from 1st to 100th and adjust the exchange-traded fund accordingly. They also do rebalancing. Every quarter in March, June, September, and December, they readjust the weight of each stock so that it doesn't exceed the set limits, 4% per individual stock and 25% per sector. That's how it works. Seen this way, it's convenient since the exchange-traded fund handles all the complex adjustments, rebalancing, and composition changes, so investors don't have to worry. It's great, but here, there's one more question we need to ask. As I always say, when we select stocks, we need to do a relative evaluation, not an absolute one. I really like the SCHD exchange-traded fund, but the question is this the best choice? That's something we need to ask. Personally, I think so. As an investment to cover living expenses after retirement, I personally think SPY or QQQ, or if you want to be a bit more aggressive, SMH are the best choices. Now, as shown in the table below, whether you should write it or not. Instead, should investors be the ones to write it, or should investors be the ones to pay attention to it? Should we be concerned about it? Maybe investors should be the ones to pay attention instead of us. Maybe investors should be the ones to write it. instead of us. Maybe investors should be the ones instead of us. Maybe investors should be the ones to care instead of us. Maybe investors should be the ones to pay attention instead of us. Currently, SCHD's dividend yield is not 4%, it's 3.8%. What that means is if you just invest in something like SPYQQQ or SMH, even if we withdraw 4% or maybe up to 6% each year for living expenses, there's nothing to worry about. In fact, it's more likely that your investment funds will increase rather than decrease. On top of that, these three ETFs also pay dividends. The dividend yield is low, but it's not something you can ignore. First, SPY has a dividend yield of 1.08%, QQQ is at 0.47%, and SMH is at 0.31%. And if you look at the dividend growth rate over the past 3 years, it's 5.51%, 12.89%, and 10.84%. The 5-year average growth rates are 5%, 11%, and 0.19%. So not only are the dividend yields decent, but they also keep growing. That's something you should keep in mind as well. However, there's a reason why I recommend SPY, which tracks the S&P 500 QQQ, which tracks the NASDAQ 100 and SMH, which bets on the top semiconductor companies, over SEED, which focuses on dividend yields. That's because these are the investment options that quickly and accurately reflect the changes happening in the world. It's because I believe that nothing compares to SPY, QQQ, and SMH. Investment allocation is based on market capitalization, including for SEED. However, in the case of SEED, there are limits on the allocation to prevent excessive investment in specific stocks or sectors. But that's not the case for SPY or QQQ. They're directly reflecting the changes in the world in their exchange-traded fund allocations. So, if a particular sector or stock dominates the world, the investment allocation to that stock or sector can increase infinitely. Keep this in mind. As we continue to age and eventually retire, it's almost impossible to constantly follow, understand, and reflect the changes in the world and update our investment strategies ourselves after retirement. So, when the time comes in the future, when I also start to feel that investing in individual stocks is getting a bit overwhelming, I'll wrap up by saying that I plan to move my investment funds to things like SPY, QQQ, or SMH. Today, I'll read one more comment. Recently, many people have been interested in the outlook for Bitcoin and Ethereum. This is a question left by someone using the identification style Simpon. Hello, sir. I always watch your content gratefully. I'm not concerned about the other United States stock top picks, but the cryptocurrency sector has been falling a lot recently. What should I do? I've already missed the selling point, so I'm just watching for now. What it is an interest rate cut. Just a few weeks ago, this was the opinion of over 95% of the market. But then this probability suddenly dropped below 50%. So the price currently reflected in the market was based on the assumption that the base interest rate would be cut at least one more time. As this assumption disappeared, concerns arose that the Fed might take a more hawkish stance than expected, which suddenly reduced the preference for risk assets. This is the first reason, and the second reason why cryptocurrencies have suddenly collapsed recently is because the excessive leverage that had been building up all this time collapsed all at once. You all probably remember, when President Turiompo took office, many believed cryptocurrencies would keep rising. That's why so many investors used high leverage and invested their funds recklessly. You can see it that way. So, as this speculative money was wiped out all at once, the decline was actually excessively amplified. You can see it that way. Now, the first and second factors are short-term factors. For example, macroeconomic uncertainty. Interest rates will eventually keep dropping, right? So when the cycle starts again, this uncertainty will disappear. The second factor, excessive leverage, has nearly been eliminated. Therefore, the first and second factors have already been resolved. If only the third factor is resolved, everything will be fine. But it's serious. It's the whale's departure. Originally, this also applied to the cryptocurrency sector. The typical pattern is that long-term holders keep holding on, while short-term investors get shaken out. However, this recent downturn is somewhat different. This year, even held coins were partly sold for profit or risk reduction. As big players sold Bitcoin and Ethereum, we saw more downward movement. That's the perspective to take. So let me share my personal outlook with you. For these various reasons, the short-term outlook is still uncertain. I think we need to be very cautious. Because of that, as you know, all the stocks I've recently bought at a low price are artificial intelligence beneficiaries. I haven't been adding to my positions in cryptocurrency stocks. Of course, the decline is even greater, and technically speaking as well. Bitcoin is currently trading below its 200-day moving average, which is a major support level. And since the psychological support level of $100,000 has been broken, there is still plenty of room for further decline. Now, to say something a bit more positive, it's the end of the year. So, if the Fed either cuts interest rates further or gives the impression that it will do so soon, and if a Santa rally happens due to seasonal factors, then there's a higher chance that we'll see a gradual recovery trend. Now, I'll give you one more thing. I don't think I've ever shown you this chart before. There's something called the Crypto Fear and Greed Index that shows the sentiment of the cryptocurrency market. So I posted that the Crypto Fear and Greed Index had dropped to 17, but when I checked again just now, it had fallen to 15. Now, to give you an idea of how low 15 is, the last time it dropped to 15 was on April 9, 2025. That was also the day when the stock market hit rock bottom. So right now, the Fear and Greed Index for cryptocurrencies is showing extreme fear. That's why the possibility of this being the bottom is gradually increasing, and we can view this as a positive sign. However, for the market to make a meaningful rise again in the mid to long term, I personally think that either the uncertainty around interest rates needs to be completely resolved, or there needs to be some new regulatory environment, like President Trump announcing a good policy, or some other external momentum is needed. Therefore, until the direction shifts again, it seems wise to take a conservative approach while preparing for volatility. If you buy now, it could drop again. Since it's a falling knife, we think it's better to buy after it bottoms out and shows an upward trend, even if it's already up 10% or 20% from the bottom. Next time, I'll summarize yesterday's United States stock market conditions. First, check the S&P 500 map. Yesterday, all stocks except Google were wiped out. Only Google is clearly in the green. The rest of the top 500 companies were mostly trending downward. So market breadth has narrowed significantly. Now, only 36% of stocks are above their 50-day moving average, meaning only that percentage has a good short-term trend. And even the number of stocks with a good long-term trend has dropped to 51%. So, since the market breadth keeps narrowing, I told you this is a bad sign. We don't know how long it will keep dropping, but if the market breadth continues to decline, there's a chance it could fall to around 20 or even 15 before the market hits bottom. Therefore, thinking that this is the bottom right now feels more like we're just at the beginning of the decline. Next is change. This is the volatility index, and it's the same here. As I've said before in the case of the VIX, it's not good if it goes over 20, and it's not good if it's above the 20 zero-day moving average. Right now, it's gone up to 22.38. It's above both the historical and 200-day moving averages. But that doesn't mean there's excessive fear either. It needs to be around 30 for it to feel like fear has really spread too much. The index suggests a continued downward trend. That's our assessment. Next is the Fear and Greed Index. Extreme fear, it dropped to 15. Let's take a quick look at how low 15 actually is. Back in April, this index once recorded a 4. So, if something really frightening happens, like the Trump tariffs, it could drop below 10. Of course, there's always a chance it could rebound before falling below 10. The chart you're seeing now is the S&P 500 stock chart for 1 year, and the decline isn't as big as you might think. And on Mijihun channel, we found about 2 more opportunities to buy additionally. The first time was when it broke below the 21-day moving average, and the second time was at the 51-day moving average. Now, even the 51-day moving average has been broken. If that happens, the third support line is here. So, where is this? It's around 6,540. Therefore, if it drops to 6,540, I think that's another buying opportunity. If it falls below this level, the decline could get even bigger. At that point, we can't completely rule out the possibility of it dropping all the way to the 200-day moving average, but personally, I find it a bit doubtful that it would fall that far. In my opinion, I hope it will rebound around 6,540. Lastly, these are Mijuan's top picks. Yesterday, all but 6 stocks fell. Yesterday, Alphabet rose 3.12%, Telin Energy plus 2.14%, Tesla 1.13%, First Solar 0.18%, Broadcom 0.06%, and Credo 0.04%. The rest all went down. At the very bottom, you'll see Coinbase. Coinbase fell 7.06%, ProShares Ultra Ether Exchange Traded Fund dropped 8.70%, and Bitmain plunged 10.03%, performing worst. In the paid membership of Mijuan that I run, there are a variety of series. There's the Mijuan podcast that many of you know well, special Mijuan content where I post articles I've written myself, and Teota Omiju, which summarizes the most important news in the market. There are also outlooks on the United States stock market and the Today's United States Stocks videos that I often share on the Mijuan broadcast. I provide you with this wide range of content. One is Smart Machine, another is a peek into the smart portfolio. What is this? As I mentioned yesterday, United States institutions with investment funds over $100 million must report their portfolios, including stock purchases, sales, and top 10 holdings. We compile and provide this information quarterly. And the Smart Money Portfolio Sneak Peek series is divided into 2 main parts. The first part is looking at which stocks the most famous investors are currently betting on. The other part is analyzing whether hedge funds have bought more or sold a particular stock and sharing that information with you. So we've covered a lot of stocks this time, but I'd like to select 3 stocks that you're probably most curious about and share the latest updates with you. First of all, it's Nvidia. In the case of Nvidia, last quarter, 966 hedge funds held it, but now the number of hedge funds holding it has decreased by 28%. But there's one positive aspect. Now, among the hedge funds, the ones with big stakes, I'm talking about them. Among all the funds, those betting more than 5% of their total assets on Nvidia, so the big players, the number of big players actually increased from 208 to 211. Meanwhile, the number of mid-sized players decreased from 462 to 549. Now, over the past 3 months, 468 institutions bought Nvidia stock, while 443 institutions sold it. So, we can see that there are still more institutions buying than selling. Now, one more encouraging aspect is the average ranking. Nvidia's portfolio ranking improved from an average of 25.4, 4th place, to 24.4, moving up 1 spot. So, this shows that hedge funds, especially the big players, are increasing their investment in Nvidia. That's how we can sum it up. Next up is Palantir. Palantir also showed very good results. First, let's talk about the big stake. So, the number of big players originally was 15, but this time it increased to 17. The number of institutions with large shareholdings and mid-sized holders has both risen significantly. Originally, there were 119, but it increased to 123, which is more than a 3% rise. Now, if you look below, just like last quarter, the number of institutions that sold shares this quarter was only 211, while the number of institutions that bought Palantir shares was much higher at 282. And the average ranking also jumped significantly from 121st to 116th. I think this part can also be wrapped up positively. Alright, lastly, let's check just one more item. This time, it's Tesla. Among all the stocks I own, Tesla had the best hedge fund numbers this time. First of all, in the last quarter, there were a total of 615 institutions holding Tesla stock, but this time it increased to 627. And the big institutions with big stakes, meaning those that have invested more than 5% of their total funds in Tesla stock, there were originally 20, but after a 60% increase, the number rose to 32 institutions. That means major investors are now putting money into Tesla, as you can see. And third, the medium-sized investors also jumped from 206 to 235, which is a 14% increase as well. So you can see that a lot of large institutions are getting involved right now. Last quarter it was 35 and 25, but now the buying and selling volume gap has grown to 40%. So over the past 3 months, there were very few institutions that sold Tesla, and the number of institutions that bought was much higher. And if we look at Tesla's average ranking in portfolios right now, it was 95th last quarter, but this time it jumped up by 20% to 76th place. And the number of institutions that have Tesla in their top 20 holdings also increased significantly, from 145 to 186. So over the past 3 months, there hasn't been much good news about Tesla. However, despite that, we can see that institutional investors have been actively buying Tesla stock. As I briefly mentioned earlier, there are probably many investors who have been having a hard time lately because of Ethereum and Bitcoin. So today, I've prepared something a bit more positive. In today's United States stock video, Topney will appear, and another expert will also make an appearance. Both experts are now saying that the correction for Bitcoin and Ethereum is entering its final stage, and they're sharing this good news. Now, it would be good for you to see for yourself what logic they use to claim that the correction for Ethereum and Bitcoin is coming to an end. And that's it for today's United States Stock News, November 18th. Thanks for staying until the end of today's broadcast. And as I mentioned in advance, I don't think I'll be able to bring you today's United States Stock News broadcast tomorrow. I have 2 very important appointments scheduled, so I'll be taking a break from the broadcast on Wednesday and will greet you again on Thursday. Let's keep fighting together until we retire from United States stock investing. Have a great day. Thank you.
Then let's start by looking at the overall big picture. How do you see the current situation unfolding? Tom, could you speak first?
In my opinion, the market is generally quite uneasy right now. That's true for both the crypto market and the stock market. First, there was a government shutdown. Also, as questions about artificial intelligence valuations grew, related stocks and various growth stocks experienced corrections. There are 2 main overlapping issues in crypto. One is that there was a really big liquidation event on October 10th, and historically it was the largest ever. Another is that since crypto is a risk-on asset, the market is anxious about what message the Fed will deliver in December. If the Fed takes a hawkish stance, crypto investors can't help but get nervous. These factors are continuously putting downward pressure on the market. But one good thing is that the market is showing some signs of exhaustion. I mentioned DMARC Analytics, and he said that a bottom signal could appear within this week.
Do you agree?
I completely agree. I think we're getting very close to the bottom now. I think this is a great buying opportunity for long-term investors. Bitcoin peaked before the overall market correction this time, and like a canary in a coal mine, it sent a warning signal about the risks to all risk-on assets. So I believe Bitcoin will be the first to hit the bottom. Like Tom said, I think we're very close to that point right now. So I think this is a really good opportunity for investors who are looking at least a year ahead.
This time I'd like to dive a little deeper into Ethereum. What do you think are the unique factors driving the movement here? Do you think there are factors that could separate it somewhat from the overall risk environment or its correlation with the entire crypto market?
Ethereum is a smart contract platform, so it's different in nature from Bitcoin, which is a store of value. In a sense, the virtue of Bitcoin is its inertia, and that's why I see it as digital gold and a stable store of value. On the other hand, Ethereum is based on smart contracts, so it will serve as the rails on which countless things will be built in the future. One of the areas that grew significantly this year was stablecoins, and new fields like prediction markets have also emerged. This time, there are discussions about tokenizing not only the dollar, but also stocks, real estate, and alternative assets. Many of these projects will likely be built on Ethereum or Layer 2 solutions. Across the ecosystem, Ethereum is seeing increased activity with trading volume, transactions per second, and value locked on the chain all rising. So we believe that Ethereum's story is still in its early stages, and that's why we see this as a super cycle.
You said you agree with Tom's opinion, right? Do you think we're almost at the bottom now? Then do you see this as a buying opportunity from a long-term investment perspective?
I believe Bitcoin, Ethereum, and Solana present a rare once-in-a-generation chance for long-term investors. Let me elaborate on what Tom said about Ethereum. Currently, investors are anxious about many issues such as the economy, artificial intelligence, valuations, tariffs, and economic trends. That's why we need to look for structural growth trends that are less correlated with these factors. In my opinion, regardless of how the economy performs over the next year, stablecoins will see significant growth, and asset tokenization could grow tenfold in the next few years, no matter what happens with the economy. So prediction markets will become a huge market, and decentralized identity and digital identity will also experience tremendous growth. Ethereum is creating all of these structural growth trends and is entering an explosive growth phase almost regardless of the economic situation. So I really think this is a once-in-a-generation opportunity, and being able to enter at prices like these is almost like a gift for long-term investors. It's an incredible opportunity.
From an overall volatility perspective, what headwinds do you think Ethereum might face in the short term?
First of all, the industry recently went through a large-scale liquidation event, which dealt a heavy blow to many participants, and several positions were essentially wiped out. So just like in 2022 or the 2020s, I think it will take a few weeks for the industry to regain its balance. For this reason, we've seen sluggish crypto prices recently, and there are also signs that some market makers may not be able to provide enough liquidity. A decrease in liquidity has a similar effect to central bank tightening, so it's called a kind of crypto quantitative tightening. The second issue the market is concerned about is the so-called 4-year cycle debate. Many people are convinced that Bitcoin has already peaked, and since Bitcoin is the blue chip and bellwether of crypto, it's very important. If Bitcoin sets a new high this year, the logic of the 4-year cycle will be virtually invalidated. So looking at the period from now until the end of the year, I'm actually quite optimistic. The weakness at the beginning of the month on the 1st was an expected trend, and I believe that if the market rebounds, that momentum will help push Bitcoin to an all-time high.
The beginning of a dream is important, so be a little ambitious and grow little by little every day. Enjoy today's journey. Even if a dark challenge comes, I'm not afraid. Retire with United States stocks.